So look, you're broke, you don't have that much money, or heck, you don't even have a portfolio yet. But that's okay. In this video, I'm going to show you how to build your wealth with a new strategy that I have recently discovered. And this strategy is going to help you build even an account that's $500, $250, and even $50. And I'm making this video because I want to give you the power to grow a small portfolio. We all have to start somewhere. For me, I started with $2,000 back when I was 19 years old working on Wall Street. It was my first paycheck. I put it right into the market. But look, even if you have less than $2,000, you still have the ability to increase your wealth, to trade options, and to grow a portfolio steadily until you get into some bigger numbers where you can use different strategies. I'm going to be showing you how to grow a very tiny account with cheap option trading strategies. I'm going to share my screen. And to be honest, this video is going to be life-changing for you if you don't have a lot of money, because so many other influencers and content creators out there are going to show you how to buy options. However, those guys really don't care about your end result. For me, buying options with a little bit of money is basically like buying lottery tickets. You're not going to be able to have a consistent return. You're basically either going to grow your account by 3, 4, or 5x, or you're going to lose your money, be upset, and not even trade options. And that's not what I want to happen to you. I want you to steadily grow your account. And that's why my cheap option trading strategy that I'm going to cover in this video is not going to be a buying strategy. This special strategy that I'm going to show you is going to be super cheap, and it's going to let you actually consistently grow your portfolio without needing a lot of capital. And by the way, do you know what else needs no capital, or actually zero capital? Yep, that's right, smashing that like button for Uncle Henry. The more money you have, the more strategies you can implement, and the more you can grow your portfolio. However, we kind of have to throw out having more money because, as per this video title, we don't have that much money to work with. So what do we actually do? And before I jump into my screen, I just want you to keep in mind that growing a small amount of money is a very big challenge because you're very limited. You don't have that many strategies that you can use. You have to stay very focused, and you have to manage and close your position pretty much perfectly. But the good news is I will be covering how to manage and close this position in this video if you stick to the end of the video. So let's jump into this new strategy that I created, and this is going to be called the poor man's spread. All right, guys, so I'm going to be showing you this new poor man's spread, okay? The first stock I'm going to be using is Palantir. I recently did sell a put on Palantir, and Palantir ended up rising a lot after earnings. So as you can see, I'm up about $100. And I really didn't commit that much capital to Palantir. But let me show you how you can actually turn this sell put option into even less collateral up front. I put up $3,500 to make $100. But I'm going to be showing you how you can put up only $50. Yeah, that's right, just $50. So even if you have $50 to your account, then you can still make this type of trade. So first of all, I just want to point out that you want to do this strategy on a stock that has pretty much pulled back a lot and is showing some decent signs of support. For me, looking at Palantir, I knew that it was a very, very cheap stock, around $6 per share, and then has had very strong momentum. And then after this momentum has kind of cooled down and it went back down to around $7.50. And that's when I realized that this is a really good position to enter into by selling a put option. And what I'm going to be showing you is actually going to be a poor man's put credit spread. And the advantages of doing a poor man's put credit spread is going to be that, again, you don't have to put up $3,500. You can just put up about $50. So the first thing I'm going to do is go to trade Palantir options. Now, to start this position, you're going to want to go to sell put option. This is going to be very similar to just selling a put option. And by the way, when I sell a put option, I'm just collecting income. I'm collecting the premium because I'm selling the option. And basically what I am saying is, hey, I am ready to buy the stock. This stock is good. I see support. And the worst that can happen is if the stock ends up falling down or pulling back, you will have to buy the stock. So selling a put is a very advantageous position to be in. You actually get to purchase a stock, you pick the stock, you pick the strike price, and the worst that happens is you have to buy the stock if the stock ends up pulling back. Now, I don't know about you, but most people have to buy the stock at $8.65 if they're buying the stock itself. However, if you're selling a put option, then you can buy the stock for lower than it's currently worth. Okay, so you can see here that I have made a lot of money on the $7 put. I just opened this position yesterday and I've already made $100 in one day. So this was a really easy position to make money on. However, what I'm going to do right now is show you how to do that without even needing the $7. And basically $7 is $700. I'm going to show you how to not need even $700. Meaning if you have a tiny portfolio, this is the cheapest option trading strategy that you can literally get into. Okay, I'm going to be picking a different expiration date. I'm going to pick about 30 days out. If you're watching this video in the future, you can always pick an option that is 1 week to 6 weeks out. And the reason is if you're selling options and these options are expiring pretty quickly, meaning in 1 to 6 weeks, the time decay or the theta, let me quickly show you if I expand this option, this theta number right here is fairly big and it's also decaying much quicker. That means in just the next 1 to 4 weeks, this option is going to be worth $0 and currently it's worth $11, but it's going to go down to $0 and that's going to happen much faster. Now theta is much lower if there's a long time until expiration, which is why I prefer to sell options 1 to 6 weeks. Now, check this out. I'm going to have to pick a strike. Now, Palantir has increased a lot, so it's up 13%, and I did make a bet where I made $100 on that. But, let's just say that we believe that Palantir, or whatever stock, right? It doesn't matter. It doesn't have to be Palantir. It just has to be literally any stock. I'll actually show you multiple examples, but let's just start off with the first one. Let's say we don't think it's going to go below $8. So here's what I can do. I can end up selling the $8 put, okay? This means I'm going to have to put up about $766. That's too much. What I'm going to do now is I'm going to buy another put. Now this other put is going to function basically as a cushion. It means that I don't have to put up as much collateral because if this stock were to go down to 0, in theory, Robinhood or whatever brokerage you're using will have to actually tie up this collateral. It has to tie it up because there is a, tiny risk that the stock could end up falling a lot, okay? But that risk you're going to cushion and it's not actually going to affect you if you end up buying a leg lower. And what I mean by leg lower is this is the $8 leg that you're selling, but then you're going to buy one leg lower, which is going to be the $7 strike. So if I end up buying this strike price right here, you will now see that I'm collecting $22, which is pretty good, but I'm only risking about $77. That means I'm roughly almost getting a 33% return. This is almost 1/3 in about 30 days. So I'm basically getting a 30% return in 30 days. That's 1% per day on this position right here with a tiny portfolio. Now, some of the risks and benefits here, it's actually insane if I think about it. A big portfolio cannot really get 30% per month. That's honestly not going to happen, right? If I have $2 million, I get 30%, then I'm going to be making $600,000 in a month. That would be insane. I'd be able to buy 2 Lamborghinis per month. Not that I really need one, but what I'm saying is it's really hard to have a huge return on a large portfolio, but it's very easy to have a consistent small return on a large portfolio. Now with a small portfolio, the benefit is you can have a massive return. I mean, absolutely massive, 30% in 1 month. However, do keep in mind that there are risks to this position, although the risks are much less than just buying call options. What typically people do when they're new or they don't have a lot of money is they don't have that many choices. And when you don't have that many options, you kind of have to settle, and that applies for all areas of life. You need options. And if you have not that much money, your options are very, very low. You're basically pigeonholed into a position where you just have to buy options. And it's typically going to be call options. But real quick, if I just show you a call option, for example, on Palantir, a lot of people would buy like a $10 call option. The delta right here is extremely small. It's 0.26. That's not extremely small, but that means that 26% of the time you're going to make money and 3/4 of the time you're going to lose. That's why buying options doesn't work. It literally works 1 out of 4 times, and then you lose 3 out of 4 times. However, if I go back to selling this put credit spread, this poor man's put credit spread, which is only $1, in difference, 8 to 7, but the actual max loss is only 78. Well, here, your chances of winning, if I expand this right here, is also 0.3. But check this out. When you're buying an option, that 0.26 means it's your chances of winning. Here, when you're selling an option, it's actually reversed. This is the chances of someone else winning if the stock were to go down to 8. And because you're the one selling, you're not the buyer, you're a seller, that means your chances of winning are actually reversed. Rather than winning 30% of the time, you're actually going to be winning 70% of the time. So 7 out of 10 times, you're gonna end up winning this position, and 3 out of 10 times, you're gonna have to do something. And let's talk about that something. What will you actually have to do? And this is actually the most important thing, because if you don't know how to manage a position, you don't know how to roll a position, which by the way, I have videos on, I'm going to link in the description on rolling. You really need to understand rolling, because with rolling, you can adjust the position, save it, make it more profitable, or reduce your losses, okay? So saving a position, you can do it by adjusting and rolling, or you can honestly just close a position if you really need to. If you end up winning 7 out of 10 times, but you close it for a small loss, not a total loss, okay? Big difference. Please write this down, okay? Close for a small loss, not a total loss. What I mean by that, okay? A total loss would look like this. You wait until expiration day on the very last day, and this option has been in the money, and you end up losing $78. That is what you don't want to do. What you do want to do is say that the stock ends up pulling back a little bit, okay? The stock, for example, right now is currently $8.69 per share, and our buffer zone or our break-even zone is around $8 per share. In fact, it's going to be a little bit less than $8 per share, because $8 per share right here is where the option starts to kind of lose value. But this area right here in between is the cushion that you have, and this cushion is going to translate into about $22. So as you can see right here, your actual break-even price is going to be $7.78. That's because you're being cushioned by $22 or 22 cents, since each option is 100 shares. So right here, your break even is $7.78. That means you won't be losing money. Now, how do you actually manage this position in between? Because a lot can happen, right? So let's go over scenario analysis. What I'm going to explain right now is, depending on the price of the stock, will depend on if you close this position, if you roll this position, or if you just leave it alone. Ideally, you just leave it alone, you make $22, about 30% on your money in 30 days, and you're happy, and you just do it again, right? What I do is I make consistent weekly and monthly income. That's actually what I teach in my Discord community. I'm literally just showing every single trade that I make, and you can always join that community by clicking the first link in the description. Now, scenario number 1 is if the stock ends up continuing to go up, then you're in good shape, because this is a bullish strategy. A poor man's spread is a bullish strategy if you're doing a poor man's put credit spread, right? It means that as long as the stock is going up, you're gonna be in this green zone. That means you don't have to do anything. You can relax, you can go on vacation as you wish. You don't have to really touch this position. You're gonna let it expire, you're gonna let it go to expiration as long as it's in this zone right here above this zone of the current stock price. This is a very easy zone. This is a very happy zone. This is the zone that you ideally want to stay in, meaning you want to pick stocks that are ideally having a good momentum higher. They're moving higher, they're increasing in value, they're growing. Then this strategy is really ideal, is stress-free. Now, in scenario number 2, the stock could end up falling a little bit. If it's in this area, you still basically do nothing, but you can monitor it a little bit closer. So I like to look at my positions maybe 3 times a week, once a day, for just 5 minutes. But if this position starts going closer into this area, you may want to start looking at it maybe 2 times a day and just make sure that this position is still in the green zone. Now, once it goes right here at $8 per share, this is basically your first red flag, okay? This is the first red flag where it hits your first initial strike price. You're still in the green, you're still making money, but now you have to start asking yourself, is this stock likely to continue falling? And if the chances of the stock are likely to continue falling based on technical analysis, which I do teach in my Discord community as well, if it is likely to continue falling, then what you're gonna wanna do is start thinking about potentially closing this position. However, you can close it right away if you do believe the stock is more than 50% likely to fall. If you see the momentum has completely shifted, you would wanna end up just closing this position right here, and depending on how many days are left, honestly, you might end up even breaking even or losing a very small amount. So you might end up losing potentially 10 or 20 bucks. So that would be a break even on your money, okay? That would not even be a big deal. And this is going to happen probably about 30% of the time, given the delta right here, about 28. So it's gonna happen about 28% of the time. It is going to start to be around this area. And you can ask yourself, hey, if on the technical chart the momentum has shifted, I'm going to end up just closing this position. If the stock ends up going down right here to your break-even price of $7.79 now, since this has changed a little bit, then I would really consider closing this position, if especially the position has not lost you much money. In most cases, even when it does reach this point right here and there's a few days left, you're still going to be able to close this position for maybe a $10 loss, which is not a big deal. This is the areas that I will end up closing this position. Now, in some rare instances, the stock will have a very large move downwards and you will be right here. And if the stock ends up going right here, and this happens very quickly, I just end up closing this position. Obviously the momentum has completely changed and I take a loss, okay? This loss can end up being around, half of the maximum loss right here. So this could be $40. That would be the maximum loss I would try to take. I would not try to take more than a 50% loss of what I'm risking, okay? So right here I'm risking 80. I would try not to ever lose more than $40. Now, there's also another scenario, okay? Say that the stock goes down here and there's still a lot of time left, but the momentum is negative. However, you don't think the stock is going to fall that much lower. You think the stock is fairly stable, it has pulled back a lot, it's become a lot better of a bargain, okay? A lot of investors are probably gonna start scooping it up in the next few days to a couple weeks, and let's say you still have a couple weeks to go in your 30-day period. What I would do in that case, and this is going to be really interesting, is you will actually end up closing this position but opening up a new position, which is going to be called a roll, okay? That means you're going to reverse this trade. So instead of selling this $8 put, you're going to reverse it by buying an $8 put and then selling a $7 put. And then you're going to open up a new position. This new position, so let me get rid of 8 and 7. Okay, I'm going to get rid of 8 and 7. Now your new position is going to be 7. You're going to sell a $7 put option and then buy a $6 put option. Okay, so you're basically in a very similar position. It's a very identical position in many ways, except now your strike prices are lower and you're giving yourself more room for the stock to potentially fall. Of course, you hope it doesn't fall. But now, again, you're in a situation where you're gonna be in the green zone and you're gonna collect more money on the position. I don't wanna make this video too long, so make sure that you are subscribed to this YouTube channel. Make sure that you comment if you want more videos like this. And I have a whole small account playlist that you have to watch if you don't have a large portfolio and you're trying to grow and compound your wealth.